Hello, everyone. Thank you so much for watching this property update and sale update video for Oak Hollow. This also acts as our 1031 update for the partnership, and we're ready to dive in here and kind of go through some timeline dates and really discuss where we are capital stack wise for this particular deal.
We know we're going through a sale, so we want to touch base on how do we get here? Where do we start? It's exciting to the standpoint that this deal was purchased with a 1031 from Foxwood. And Foxwood was our number 6 deal that we bought all the way back in August of 2012. So we're coming up on 10 years now with this investor pool and these two deals. So one, if you've been in those 1031s, thank you very much. It's been a long road and we've done very well together. So we're very appreciative of that.
Absolutely.
And then mixed into Oak Hollow, we had $965,000 of fresh equity that also came in. So we have a mix of fresh equity and our 1031 money. For Oak Hollow specifically, we purchased this in 2019, right in the beginning of the year. We paid $3.5 million. And since acquisition, we have not been able to make any distributions. That is why we're at the sale table right now. We have not been able to turn this thing into a cash flowing asset that we like to see. And over that time, we've accrued over $550,000 of accrued preferred returns. But the good news, we have a sale pending here on February 23rd. That's our latest date for $7.275 million. That's a good price, and we're excited to exit at that position. Want to talk a little bit about how we got here, though.
Right. What we projected we were going to be at this time versus where our rents are specifically currently. I see that operationally we met our performer rents here.
Yeah, we were trying to get $850 per month. That was our targeted average. And on our cover sheets, we have it on there. That's right
on target.
Yeah, we're right there now. It just took us 3 years to get there instead of one. And a lot of that was from delays really in the heart of 2020 is when we were going through the renovations here. We had a few units where we had residents that were non-paying for a couple months at a time. So if they were in there for 9 months and not paying, we could not do the renovation on the property. That really pushed back our timeline. And then also we were over on our renovation budget. We targeted $811,000 and we ended up right at $1.1 million. So not only were we over on time, we were over on cost here too. Normally that's not a great combination and results in a higher cost basis. When we look at our capital stack as a whole, starting at the top here, we have our current assets of just over $100,000. That's our current cash that we're sitting on. We have our building at 3.6 and our improvements, again, a little over target, so sitting at $1.1 million right now. When we go into our liability side, here's where it gets a little interesting.
Yeah, I do see that line item of retained earnings. Can you go a little deeper on that item?
Yeah, it's negative. So we got negative $394,000. And this is essentially negative cash flow for the time frame that we owned the deal. So day one, we go into construction and people are leaving and we're cash flow negative. So that's our retained earnings there. And then starting from the top there down, AP 75,000. Our loan from GP, this is a rather large number. We've got $565,000 here. And this is really propping up the negative cash flow and the overage on the CapEx. That's what that money was contributed for. And then we have our debt. We got a loan with CBRE. So this is our debt on the deal and our original investor equity. Another part that's good is preferred returns, right? We want to know how much we owe in preferred returns on any given deal.
Right, and something that Greenleaf does is really calculate it on a per day basis, right? So this is specifically from all the way up to February 23rd, which is that date of the sale.
Right.
So we're calculating it on a prorated basis, correct?
Correct. Yep. So in the details here, our preferred return is 8%. We purchased this on January 7th of 2019, and we're projecting to sell it on February 23rd of 2022. That'll mean we owned this deal for 1,143 days exactly. So now we have
specific.
oddly, yes, very specific. So we have our per day rate and our total percentage owed on our original equity, and that gets us to this $573,000 of deferred preferred returns. And this number will fluctuate a little bit as we get to the closing date. If we close a day or two before, this number will change based on what that exact exit date of the asset is.
Right. So can we dive in a little more about how the cash flow is working here?
Yeah, definitely. So cash flow, we're selling this for the $7.275 million. We have about $215,000 of closing costs. That always gets paid first. That's the attorneys. And we have debt. Again, this is with CBRE. So we are looking at our current debt plus a 4% prepayment penalty. So another 4% on top of that. That's why we see $2.448 million here as our payment. The next thing to come out is our AP of $75,000. And then we have preferred returns. This came right from that preferred return distribution sheet of $573,000. And then we have our return of capital. And lastly, the loan from the GP of $565,000. So that leaves us with remaining cash or profits of $1.1 million. And that follows our normal profit split of 70-30 between the LP and the GP position.
Perfect. Well, can we go one step deeper and really look at it from a distributions side?
Yeah, so when we look at our distributions to LPs and what those returns look like, here we have our existing equity that we've covered, we have our preferred returns, and we have our profit sharing. That total equals $3.6 million. It represents essentially, for every $50,000 that was invested, each investor is going to receive $80,000 in return. That equates to a 15.8% IRR and essentially a 1.6x multiple on equity over the 3-year period.
Right. So you did mention 1031 here. We're super excited to offer the partnership a 1031 exchange. Can we just speak very quickly on what this looks like maybe tax-wise if you were a third-generation 1031 participant?
Yeah, so it's pretty cool from a tax standpoint. You know, we did the Foxwood deal. We 1031 that profit into Oak Hollow, and now we're going to compound those profits again with the Oak Hollow sale and reinvest that into a new asset. So there's no tax consequences for anyone who stays with the 1031. Doesn't, first generation or second generation, people can roll with it. But if you do take your money out, it is just normal capital gains that we pay on this because we held it for longer than a year.
Gotcha.
Oddly enough, a lot of our recent deals are right here in Norcross. Norcross is right on 85, headed north out of Atlanta. Our corridor, 85 all the way up to Raleigh, is something we've always focused on. So now we have 2 deals that are located really right in our backyard, both right here in Norcross. We have a few other deals that are also candidates for this. We don't have anything that's like firm and through the due diligence where we fully send it out. So these are 2 examples of deals that we do have that are kind of further along in the process that we could roll in our 1031 funds to. So the first one is Dawson Flex. This is a currently occupied warehouse with a little bit of office. So it's like a flex deal, but the market rates are well above the current rents that are at this asset. So this would be a candidate where we can come in, allow people to leave when their leases are up, renovate the spaces, and renew them at the much higher industrial flex rates that we're currently seeing in the market. That would be positive.
Right. This is very similar to the Carter Oak
Carter Oak
deal
that we just did. Yes. Yep. And the other one is Henderson Mill. This one also right here in Norcross, but it is leased to predominantly government and medical tenants. It's 73,000 square feet for $9 million. We're still digging through the details on this one, but it has excellent tenants. That's why we like this. So we've been doing a split of medical, government, and then this industrial flex on the really the last half dozen deals we've done. So we're excited about these 2 opportunities. We're going to have a lot more details that come out, especially as we get closer to the closing timeline.
Like we mentioned before, we do have a target closing of February 23rd, and then we do have around, we said 180 days post-closing to properly and formally identify and close on that replacement property, which puts us right at July of 2022.
In another part here too, if you're watching this today, January 20th, all of our distributions went out. So we are excited to have all of our financials out for the year, wrapping up 2021. All the cash payments went out as well. So if you have a deal that made distributions, which many of them did, including profits, you should see those hitting anywhere between today and Monday, really. That's when cash should hit all of your accounts. We're excited about that. And next week, we have a couple live Q&A sessions to go through anything from the cover pages, anything from the deals that you have questions on. We'll be able to address those there, and we're going to send out, everyone should be getting announcements and registrations for those so they know the exact times and what we'll be covering. Thanks, everyone. Have a good rest of the day.